Hello, everyone. Liquidity can look very different across markets, especially in Asia. Access, product mix, and investor habits all play a role, and those differences become even more important when markets are under stress. This session brings together global and local experts to discuss volatility, diversification, trust, and how liquidity relationships are changing in a more automated market. Please welcome our moderator, Mohamed Isbir, from Equity Capital. Together with our panelists, I'll give them a round of applause as they take the stage.
Hello? Yeah. Sorry, thank you, Natasha, and thank you all for attending the event and attending our panel. We hope that we can, give you some good information today. Our topic is liquidity and how liquidity has been affected by the volatility that we've seen in the last couple of months. We have an amazing, group of panelists with us, and I'm going to give everyone maybe 30 seconds to introduce yourselves, and then we'll start digging into the questions. Please.
Thanks, Mo. Hi, Alex McKinnon from Finalto. We're an MAS-regulated broker and global broker, and we're very pleased to be here and amongst fellow colleagues on the panel.
I'm Stavros from Marsh Prime. We provide liquidity to brokers the last 7-10 years, and our clients are institutional clients.
Hello, hi everyone. I'm Grace from Philip Nova. We are a local Singapore-based brokerage that provides multi-assets trading to a variety of clients.
Hi there. Thanks for skipping your lunch to listen to us. I'm Jan from Wintermute. We started 9 years ago, and we've grown to be essentially the largest spot crypto market maker. So we do about 15% of the volumes globally. And then we've slowly ventured into gold, into oil, and we look at more and more TradFi assets from last year.
Hi, this is Vinay. I'm from SGX Group. In Singapore, we also are quasi-regulator. We are a multi-asset exchange providing liquidity into equities, futures, fixed income, FX, and digital assets. I look after the FX and digital asset domain for SGX FX. Both from the solutioning point of view and also from the liquidity point of view. And our client segment is very diversified. We service asset managers, sovereign fund, hedge funds, bank brokers, and crypto houses. Good to be part of the panel today.
Thank you all. And as you can see, we have a lot of different backgrounds. Some people coming from the liquidity space, some people coming from the tech space and the local brokerage space, which is going to enrich the type of conversation that we have today. And I want to start with the first thing is the volatility that we've seen in the last I would say by Q4 and Q4 25 and Q1 26. And the focus in this is mainly the liquidity that we've seen in the FX and CFD space. We see a bit of fragmentation. And if you look at the prices, we see the prices that comes from the banks. And then you see the prices that the retail traders are working on. And then you see that there's a decent gap between what you see in the actual market and how the prices are coming and how it is today. And there's two sides of this equation. You've got the technology side and how each broker or price maker constructs their own liquidity. And also the other side is the risk-taking side and how much you internalize parts of that and how you construct your pricing engine to be able to take certain risks on board. That fragmentation, I want to start, the conversation by talking about that fragmentation and is the volatility that happened in the recent months, has it increased that fragmentation? Is the liquidity that we see in the market now is true liquidity, or is it just some brokers running their own retail books and B books? Sorry, maybe we start with you, Alex. I mean, you have a lot of visibility on this and.
Yeah, I think the fragmentation's still there. It's probably narrowed a bit. I think when, as you said, the Q4 of last year, when gold really started to rally and silver, the retail brokers were still competing to gain that retail customer base. So they were sub 10 cents when the real market's probably 30. So I think now that the retail space has moved into a more realistic area of north of 15 cents, it's helped us from a liquidity provider to that space. But now they see our real spreads, the interbank spreads, a lot more realistic. But they are taking on a lot of risk and then externalizing with us on a more realistic spread. But we're still getting pressured to narrow those where we can. But there's only certain things you can do.
I mean, Stavros, have you seen this? Have you seen also, clients are becoming a bit more reasonable with their demands in the last couple of months?
Yeah, of course it depends on the model that the broker is running, on the risk-based approach that each broker has is different. But I agree with Alex, yes, the fragmentation is still there. We are trying to do the best we can to accommodate the brokers. Pricing now is more demanding. We have been seeing a big shift on the metas lately, which still you need to be careful on the hits, or you need to aggregate more liquidity to satisfy the clients, because the books are making more, let's say, widening sometimes or thinner. So you need to be careful, aggregate more liquidity and try to do the best, providing the best pricing. But the brokers run different models. So we see sometimes retail brokers provide very, very tight, let's say, below the market conditions, which this you can do only if you have your own books and artificial books, let's say, because the market spreads are quite higher than it's not normal trading conditions, but it depends on the model and the balance sheet that each broker has, because you need to have a big balance sheet to provide these below market conditions to absorb the loss. As we saw, there was some big hits or some gaps, the last weeks, last months. It's unpredictable. So you need the money to be able to sustain this and, of course, pay the clients if there is big hits. So it all depends on the risk approach of each broker, I would say.
Yeah. Grace, you want to?
Yeah. I think the fragmentation of liquidity did not only happen from the last quarter of last year onwards, but volatility probably put it into the limelight. So I think in terms of maybe I'll talk a little bit about the internalization of the flows. So I think it really depends on the variety of clients that you get as well. So if you have, on one hand, the individual traders, retail clients, and also have the corporate traders, as well as maybe some institutional ones. So this mix of client can actually, buffer the effect of this liquidity issue, right, from a broker's perspective. I think on the other hand, for a broker like us, we do a variety of products. So the clients don't only just focus on, say, maybe FX or CFD. Some of them do derivatives, and they have hedging needs for currencies. So it did not come purely from a speculative angle, but also from a hedging angle. So I think that, in a way, helps us with the balancing out of our flow and the liquidity. Yeah,
definitely distribute the risk. Having multi-assets in your platform definitely distributes the risk. I think we're trying to. I mean, Johan, if you want to weigh in as well, but the kind of the main topic for me is the gold maybe, which kind of takes a lot of the the spotlight today, and the most fragmented liquidity that we see today is in commodities, because it's in high demand, and the gap between the banking prices and the retail prices is quite huge. Johan, do you have anything to add on this?
So two main comments. I think one first is structurally, from a crypto perspective, we've seen a big liquidity change from 1010. So we had two extra million accounts that were highly levered pre-1010, and these were wiped out then. And then we've seen or some people discovered ADL at the time, so the auto-deleveraging from exchanges. And then it turned out that many crypto exchanges were actually using ADL, and it forced people like us to, instead of being sometimes 40-50% of the open interest, and being down to 20 or slightly lower, which means that typically people like us who offer a lot more liquidity in the crypto space, had to be a bit more risk conscious. That means that actually, in the backdrop of essentially a lot of geopolitical changes and a lot of movements and essentially a shift in volatility from crypto towards more FX or commodities, you end up in a landscape where You're not in crypto 2017 anymore where people are quite isolated, where you can't off-ramp and then you basically step in the ecosystem. Now you have overlap between the fact that you can actually fairly fluidly move your funds from crypto into traditional finance assets. And also the trading, the group of traders is basically the same. The speculators who are just going to shift to what the volatility is. And this is where you see people, so we started to cover gold last year, mostly OTC derivatives, to be honest, mostly options. And now tokenized gold is becoming a primary discussion with a lot of CFD brokers so that we can actually cover gold over the weekend. Oil is also becoming a big subject. And it's all about, sure, there's this fragmented liquidity, but it's also essentially where the speculator wants to go. Now, I don't have like great visibility on like retail flow. We only face really institutions. So we basically going to be second degree to retail flow. There's always we help a CFD broker to hedge their flow at best. So we tend to deal with more people who are just very price sensitive, very tech latency sensitive, but not really the rest.
Right. Okay, great. And Vinay, maybe just hovering around the same topic, you guys see it from a technology and a platform provider perspective. So do you see that, pricing going into the platform, pricing going out? Do you see that fragmentation firsthand?
I mean, I personally feel that when events like these happen, it actually exposes the underlying structure of the market. Because if you see, when such event happens, there's always a tendency for flight to safety. And what is that flight to safety? People want to go back to those market makers who are holding some inventory, who have a smart risk management, which means they can genuinely actually skew the price in the market as a risk transfer feed. Or people want to go back to primary markets and secondary markets where there's some kind of a marketplace. The moment you try to go bilateral in these kind of times, you will always see a difference between what they are getting versus what you're gonna get. Which means the access to that multidimensional liquidity where you can tap into an exchange for your discretionary futures hedging, you can tap into a primary market, you can tap into a secondary market, ECNs, whether it's Hotspot, FastMatch, Gain GTX, Currency Node. That gives you some access where you can centralize and avoid the fragmentation. Otherwise, if you are purely trading with recyclers, this market exposes them very badly. That's what I feel.
Right. Grace, you mentioned something really important, and I think it wasn't like in my head a great topic of discussion in my opinion, but there's a heavy reliance in the industry, in the FX and CFD industry, on metals. And you mentioned that, you guys do a lot of different assets, and maybe something that we need to talk about, how can we move the industry, the FX and CFDs industry from, it's a problem that we've been talking about for the last 5 years, that everyone is trading gold more than anything else. And it seems like, this problem is just becoming, more problematic because the more volatility that happens in the market, there's more fragmentation and gold liquidity, but a lot more clients are still interested. I guess maybe just ideas, and I think this is, you started the conversation, so maybe you can help. How can we try and shift clients and induce clients to start engaging more other asset classes and remove that pressure on metals particularly?
Wow, tough one. Well, gold has been the asset that, investors and traders and bettors have been trading for a really long time. But over the last maybe 5, 10 years, we see more speculators than ever. At least I do see that than ever when as compared with when I first started in the industry. So if we talk about how do you shift this group of people who are trading gold now and say, hey, can you trade maybe something else, another asset class? Yeah, what is a good alternative? I don't know. But, well, at least for me, I may say, hey, maybe you want to try the derivatives market. That could be a choice. Similarly, for oil, I think it's happened in the CFD space for a really long time now. It's in the derivative space for a long time as well. So that alternative gives client choice. Yeah, we are not saying that this asset class has higher liquidity than the other. At the end of the day, I think what we are trying to do is, when the liquidity dries up or gets lower, we do not want clients to be stuck in a position where, they can't get out and we are stuck as well. So yeah, shifting them from one asset to the other may not be easy. Maybe like what you mentioned, from gold to crypto, that could be a choice.
Yeah, I'm gonna go to you, Yuan, because this is I believe this is and this just come to me now, but from Grace. But I can assure you that's like one of the one or two priorities that all of the brokers have today. How do we reduce our exposure on gold and concentration risk? You seem to be a crypto enthusiast.
So I funnily enough, I moved into crypto because I had covered pretty much every other asset. So I used to trade. So I started to trade 22 years ago. Traded interest rates. Listen to central bankers and trying to understand how that will impact the curve. So I'm old enough to have traded on the Greenspan. So it's you get a view and you express this view in interest rates, but interest rate is not super exciting. It's a 2 to 6% vol basically at the time. And then how do you make your money? You make your money by, essentially getting 100x from David Amro or someone else. And I think it's the shifting liquidity or shifting interest from some of the main commodities it's an interesting goal. I think it seems to be that this is why people want to express their views now, because it's actually where it's the cheapest, most likely, or where they can get the most leverage most of the time. So of course in crypto there's been the temptation for people to get 50 or 100x or so availability on perpetual futures or whatnot. I think it's always tricky when you have a 40, 50, 120% volatility asset and you put 100x on it. You're basically going to get wiped out very, very quickly. So it's probably not the smartest thing to do. I think you can move into, of course, restart the digital gold narrative of Bitcoin, for example. And I think it's been sold from Tudor and the later 2019 already. And it's been seen as a macro asset already for some time. It's realized to a degree, but I think we can even move. Talking about metals, I was looking at trying to put a bet. So sadly, Wintermute doesn't cover copper, for example, yet. But if you think of metals and then if you want a derivative bet on AI as such, copper is an interesting one around infra, and then you have like one index future that trades like $1 million a day, and then you have the CME futures, but then you have it's actually very difficult to even get in a so well-known metal like copper. It's very difficult to get exposure. So it's also one of the dimensions you can go down to.
Okay. Anyone else would like to?
I just want to add one thing that maybe even whether we are an exchange or a market maker or a broker, we can't dictate what client wants to trade or not. Yeah. What we can actually do is that if client is interested in trading that asset class, how can we create that sort of a market infrastructure to them so that they can enter into their position nicely and they can also find an exit. So for example, what we do on our side, because we service a lot of global hedge funds, and sometimes they have big positions, and sometimes they also have to clear that risk out, whether in and out. So we say, okay, fine, then maybe use algos, maybe you slice the order out, maybe you kind of use the analytics and see that if market is able to absorb your flow or not, and then create another slice and then execute in the market. If you are, let's say, finding it very difficult in a particular asset class to trade, maybe use correlation trading, because we have a basket trading tool where people actually can run their correlation, and instead of actually exiting the big position in one single asset class, you can actually use multi-asset class and then slice your order smaller with the correlation. So I think our job is to make it easy for people to trade. Yes, we can educate, but we cannot dictate what they want to trade. That's my take.
It's true. At the end of the day, we need to follow what the client wants, and I think the big question is how to change the client mentality. But it's easier said than done for sure. I'm going to come back to something also Travers said, and it's about we have the fragmentation of the liquidity, but we have a lot of internalization of flow when it comes especially to FX and gold, and that also kind of adds up to the fragmentation. I would like to say, maybe at least from where I stand today, that I've seen in the last couple of months a lot of the brokers have started to work a lot harder on their internal risk limits. They've been a bit more cautious, especially with these big market moves in in gold. I mean, guys, how do you see this? I mean, do you see a shift into, brokers moving more towards, let's actually send flow to the market. Let's not sit on obscene amounts of risk because it's becoming too dangerous nowadays.
I'll jump in front of Stavros there. Definitely from our point of view, a liquidity provider to market, the volume we're seeing from retail-facing brokers has increased. And I think that is mainly around them, as you said, they've changed their risk limits internally. Maybe they've increased the VAR model or the tolerance levels, but we definitely see a lot more. Silver's a big one, and obviously gold is continually going, but I think across the whole book, people have de-risked, and I think, Q1 probably scared a few people in how a market can move. So yeah, definitely. Volume has increased from, let's call it the buy side.
And that's a move in the right direction, right? I mean,
from our point of view, absolutely. But I think from a business-wise, I think it's a smart move and it's a good move. I mean, the industry itself doesn't want any defaults or people going down because of bad risk management. That will just put the industry back 5-10 years. Regulators will increase risk scrutiny on us, etc. So I think it's a good move, and I think people. It's the advancement in our own technologies throughout the groups, and we're understanding quicker the risk that we have on our books. So yeah,
and that reduces the fragmentation. It kind of streamlines, not entirely, but I think it streamlines where the liquidity comes from and how it's distributed in a way.
I would say yes. Yeah.
Stavros, Ian?
I totally agree that we see that most people offload more risk to the liquidity provider. I believe now is a time for all the brokers to be careful for their risk. Is one of the most important times now. We've seen like huge gaps and taking brokers big hits. So you need to be careful, yes. And we saw this a lot more, especially from small to medium brokers, that they can't afford that big hits, let's say, for example. So I believe they reduce their levels. They can accept some lower NOPs, for example. We also see a lot of increase in the toxic flow. We get some more weird flow sometimes lately, because this is all created of everything shifted to more silver and metal, say mainly. More opportunities are created there. Mispricing, a lot of mispricing, future, spot. So yes, more clients, I will say now, they offload their risk, and I believe also that this is the right way, because you need to be careful to sustain your business, yes. So it is very important, yes. Yeah, I hope so, yes.
And it's a bit more, it's to protect. At the end of the day, we're talking about retail brokers, clearing with the likes of us as well, yeah? So that eventually trickles down to underlying clients, retail clients being protected as well.
Exactly. Everything is for the protection of the retail client. You need to be able to pay when you have to and fast. So without some good liquidity or some good risk management, this can be hard. And then you can default in one day. We saw this many times. And it's not in the interest of anyone for this to happen, because this is like a domino effect in the industry.
Yeah, and you talk about fragmentation of liquidity, but there's also fragmentation of leverage, which is probably one of the reasons why gold was so volatile. I mean, people still had, I don't know what retail do now, 500, 1,000 to 1 offshore, right? So, how is that sustainable? I don't know. I mean, in the interbank market, we're at maybe 20 times leverage. So, for us, it's a big funding gap. So having a balance sheet is very important to support the retail brokers. So I think leverage has probably come down on the retail side as well. So that can be a good thing as well.
And I think that's I'll go to you, Grace. But that's what Alex said is definitely an important element. Is the importance of balance sheet in these markets. If everybody wants to offload the risk, if everybody started thinking about the limits. That difference between the A book and the B book, and how important the balance sheet in the A book model and the B book, because it's important both ways. If you're running a risk, you need the balance sheet to sustain that risk, and if you're not running risk, you need a balance sheet to be able to cover the funding gap. Grace, if you had, you had something you wanted to say.
No, I wanted to say, definitely what Alex mentioned strike a chord. After when the war started, we found ourselves extremely busy. Two things. We were starting to look at the client's position, open position, and if it gets to a level that we are not comfortable, that's where we say, okay, what should we do about it? And then the other thing is the funding. And we find ourselves also trying to look at, do you have sufficient fund for the weekend? So Friday night becomes a no longer happy hour. You can lock off at 6 and go have a drink. But we found ourselves, yes, we found ourselves looking at, okay, do we have enough funding to cater for the weekends, volatility, or Monday morning gaps? And we found ourselves looking at all these things from the client's perspective. So it's not just whether you are purely A booking or B booking, but at the end of the day, all these things falls into place. The last thing we want is, be it whether it's an individual client or corporate client, they go into an overloss situation. That gets very tricky. No one wants to look at it. But with this volatility in the background, that's our job. We have to look at it. And the other risk element of B booking now, it also may complicate the matter. So from that point, it's the fine balance of how much to be book, how much to allocate clients with what positions that they can hold based on the funds, and also assuming if there's a gap over the weekend, can that fund sustain? So yeah, it's a whole lot of work.
Yeah, we have a very similar issue, especially in the context of us starting to cover tokenized gold and tokenized oil over the weekend. So you provide liquidity, and then we have the balance sheet. A lot of safety brokers are smaller than us, and it's always the discussion of I think there's a big split between the margining they used to during the week. That may be a CME whatever margining, that may be at 3%, and then we ask them 40-50% sometimes because it does move. So it depends on the asset, of course. It depends on the customer. But there's quite a dramatic gap to really fill. So I think it's always just how do we find a good overlap? How do we find a good fit there? But there's so much customer demand to trade over the weekend that we'll find a way to do it. But it's true that the Friday evening discussion can be interesting.
Anything to add?
So we actually heard something similar from our clients, on the broker-dealer side, where they also didn't have a lot of happy hours because overnight they were supposed to, let's say, transfer millions of dollars just to keep the funding on their side when they are dealing with the prime broker. Having said that, if you are talking about, let's say, a broker to client, I personally feel that there are platforms out there, there's a technology out there where you can actually manage all three elements, which is funding, liquidity, and risk. All you need to do is that you have to have the right tools in place. If your concern was that if my client's position is going higher and higher and I need to kind of find a way to offset that risk on the funding side, then you have to use a smart margin engine where actually incrementally the moment his position goes higher, you start obviously increasing the margin requirement. And if, let's say, they are not able to fulfill that, you can start sending the margin call. I mean, I know in the insti side, sometimes relationship plays a role, so you would not obviously stop them out, but at least you will start sending them enough peelers that, guys, your position is now in a danger zone, you need to top up the account. Now, you don't want to do that after the fact. You want to do it proactively before it happens. Same way when you talk about A book versus B book. If I'm a broker today, I'll be in a tough spot because if I actually send everything on A book side, the spreads are wide, I have to cross the spread, and I'll be losing money. If I am a B book broker and I'm taking all the position in my book without having a proper risk management, I'm also doomed because there's a big mark-to-market risk which is happening, especially on the gold and the oils, you can see that. So you need to have a smart risk management tool where you know that, okay, fine, I will actually qualify the flow, I will check what are my limits, and based upon my limits, I systematically hedge my limits, hedge my risk. So to Grace's point, it's not A or B, it's about somewhere in between. You find the balance, you stay in the game. You lose the balance, you're burnt out.
Yeah, completely agree. And okay, so I think, look, we've covered a lot of topics, and the risks and fragmentation and the risks of capital. One of the risks that, I think also need to be covered as well is technology risk, especially in these volatile markets, all of this happening. We rely a lot on, pricing engines, circuit breakers, the gold and other instruments as well have been moving sometimes 5 to more than that % a day. And we've heard in the industry there's been a lot of incidents where pricing has been switched off, or I come from Dubai, and I remember at the beginning of the war, the AWS servers and the farms in Dubai were hit, and then we had a lot of outage from a lot of different places. These are big risks as well, especially with such big moves. How does brokers manage that technology risk, pricing engines, servers, data, all of that? Because that's part of the liquidity, and how a retail broker would choose their own liquidity provider, what type of questions they need to ask for.
Technology risk management in Singapore is quite a complicated thing, and I mean, a few of us will laugh on that one. But for a retail broker, a global retail broker, it's all about not disaster recovery, but business continuity. So does your liquidity provider or providers or technology providers have multi-data centers? And for me, that's a significant thing. Where if London for some reason flooded and LD4 was underwater, we can flick over to NY4 or SG3. So, I think most of us now would have that in place. 20 years ago, nobody had that in place. So the fallback there was telephones. Well, I don't think anybody has a telephone on the desk any longer, right? So definitely the business continuity around pricing in multi-data centers is the number one requirement.
Stavros, anything to add on this?
Yes, of course, you need to have the right backups from the liquidity side, but of course from the broker side, you need to have also, let's say, additional liquidity if one fails, some failovers, or automatic pricing. You need to make sure what the liquidity can provide you, your liquidity provider, and you need yourself also to have your backups. So you don't need to depend on one liquidity provider, I will say, or pricing provider, let's say. So if the risk management is done from technology side, from both liquidity and the broker, you are most likely on the safe side. You never know what will happen, of course. We've seen a lot of things, like as you mentioned, the AWS was down or something, but you need to have backup plans, yes. And this is very important for the retail, let's say, player, yes, to the trader.
There's a lot of pricing. I mean, I heard, and I'm not sure, I don't want to be spreading rumors, but there was a lot of people who stopped pricing during the big moves of gold. Do you think this was intentional, or was this circuit breakers being hit at some point? I don't know if you guys are aware of these, but when gold has done, when gold hit the all-time high at 5,500, and then it dropped around 1,000 points, a lot of people stopped pricing in that night. And I don't understand if this was a circuit breaker from their side. Is it a risk management tool for them to kind of reduce exposure, or was it a technical failure? Is that something even from a regulatory perspective, is it talked about?
I think gold is such a unique where people discover their price from. A lot of it does come from COMEX, right? And then they bring it back down to spot. So I think we didn't have too many experiences of people stop pricing, but I presume the ones that did stop were probably not pricing off their own book, but pricing off a price discovery from COMEX. Yeah. And if COMEX stopped or shut down over the end of day, then there's no pricing.
Vinay, maybe you have something to say about
I think this is where, to Alex's point, half of the liquidity is generated out of COMEX futures as a reference point. And when, let's say, basis between COMEX futures and spot gold goes haywire, that's where you will see a lot of mispricing in the market. And that's where probably what you need is that more and more players who can actually compress the basis and who can tie it to the COMEX market, one, or people running their own inventory, which allows them to have a risk transfer feed. So in such market, let's say, as I said, that if you're completely relying on somebody who's recycling the liquidity, they will obviously stop pricing in these markets because they don't have the right inventory to run the risk. So either you have the right inventory to run the risk, or you have the right technology, or you have access to proper primary market, which, by the way, this is where, when market like this happen, the importance of primary market comes in. On our currency node, when we saw actually in these markets, our volume became very high on gold because we have access to buy-side order book, which is a legit order book where people want to buy or sell, not just quote and run. And then that book was actually filling a lot of orders for people who came to hedge on the platform. So you need to have that access to the liquidity, which is more genuine. Either it's your interest or you have inventory to clear. A lack of that means you will have cases where people will run out of liquidity and they will stop pricing. Now, they can call this a circuit breaker or risk management or smart risk management or technology failure, but end of day, they didn't have a liquidity to price. Simple.
Right. Anything to add on this?
No, I would say so we didn't necessarily trade gold during that tick, so and I'm not on the so close to the infra side of the business, but what I do know is our market share goes up when things get when the markets dislocate. Yeah. So I think it's always for me it's more a function of if you have the right infra, you would actually stay in the market and quote and you do well, and you tend to do better because you tend to quote a bit wider, and it's then just a function of people just hitting a risk limit and having to, so if you have the balance sheet, you do well, you can quote a bit wider. If you don't, if you're just trading essentially on leverage, then you hit the limit and then you just can't quote at some point, or you just need to hack out of your position to be able to get back into the market, which is never pleasant. So that would be my view. Now for the specific tick and gold, I can't necessarily comment. But.
Okay, thank you. We have about 5 minutes left, so I'm going to see if anyone from the crowd has any questions for us, or we can just do a question of our own. Anyone would like to ask the panel any specific questions about liquidity? No? All right, okay, so maybe let's round up, and maybe, Alex, you brought up regulation, and that's always also a very good, I don't know, good or bad, but it's a catalyst of change in the industry, whether liquidity-wise, technology-wise. BCPs has become extremely important. I've been in Dubai in the last 4 or 5 months. We used to be BCP as a ticking a box, and now the first time we actually took out our BCPs and started looking at it. And now you started thinking, okay, maybe this wasn't just such a waste of time, because we spent a lot of time and money building these BCPs that we have never had to use. But regulation is changing, and Singapore is very advanced when it comes to regulation. Is regulation kind of making it easier for us to kind of do our business? Because volumes are growing, despite all of this increase in regulation, but volumes are growing.
Volumes are growing. Volumes are definitely growing, but I'm hate to say this, I'm pro-regulation, right? It means the business is safe, or the end client is safe. The interesting thing about it, Asia is we're very fragmented in regulation. From Australia to Singapore to Tokyo, they're along the same guidelines, but they're not the same. So it's opportunity in Asia to conduct business through 26 different regulated or unregulated areas compared to Europe. So it's a challenge for us in this part of the world, but it's also probably the bigger opportunity.
I think Grace, you had something to say.
Yeah, from a local Singapore broker perspective, to answer to your question, it is definitely not easier to run a brokerage business in Singapore under this regulatory regime. Those who are here will probably agree. Now the thing is, under this regulatory structure, yes, it does not make our job any easier. Not only do you have to look at the markets, look at clients' position, make sure you have enough fundings, and you have to also address the regulators' question. I remember after the war broke out, one of the first things that came to us was questionnaire from the regulators. How are you and your capitalization, right? So yes, we also have to address that. But on the other hand, this regulatory regime, because it is tight and strict, it gave us that reputation here that, okay, being regulated here means something. And it does have that, I guess, status in that sense. So I guess it works both sides. And it's also, again, where you find that fine balance. Singapore as a country to operate a OTCD business, I must say that it's definitely not the best location. We have restrictions on leverage, how much we can get. We have restrictions on capitalization, your RBC calculation. So, then where the kind of clients that could come to us and get attracted to us, I guess in a way it is somewhat we have to carve a niche out of it. Yeah.
Yeah, we are still not regulated here. We balance things out with a US business, a UK business that basically covers spot. So we do derivatives here. We made essentially a very conscious decision of never taking external fund. So we've raised equity and we have people who lend to us, but we don't have a fund at all. So we don't have so that reduces the scope of the regulatory risk for many ways. We are very conscious of any discussions that we may have with counterparties so that we're not providing any services or advice in any ways. And luckily for us, we just face institutions as well, which reduces the risk, but also the scope of the business in some ways. So we've looked many times at the PSA and whatnot, and it's typically things that we already do, but we don't necessarily want the extra risk. So I think it's in our case, it doesn't necessarily add much to the business, but we were likely to be more licensed in other jurisdictions very soon as well.
Can I just add?
Yeah,
because I'm
yeah, all
like
right.
the only regulator on the desk because I'm a quasi-regulator, especially for equity market, because SGX actually done double roles. It's an exchange and it's also the regulatory body for equity market. I personally feel that yes, in terms of leverage, if you have only 1:25, you kind of feel that you're getting suffocated as compared to a Cyprus or London or a Japan or Australia market. Having said that, regulation brings resilience and trust. And if you see, actually, local Singapore regulator is a much more business-friendly regulator. Singapore actually invested in last 8 years millions of dollars to build the whole SG1 ecosystem, so that local players can get local liquidity and local execution. This is never heard of, by the way, globally, where a regulator actually is so business-friendly that they're putting their money where their mouth is. So in that sense, yes, it sometimes becomes a little suffocating, but it is actually helping us to create a more sustainable system in the market.
Definitely important. Thank you, everyone. I'm sorry we ran out of time, but we appreciate the time that you guys put in. Very valuable information from all of you guys. Thank you guys for attending this, and I hope we were very helpful. And thank you, Finance Magnates, for allowing us to do this. Thank you so much.
Thank you.